We're going to be recording this webinar so you can listen in. All right, so let's just go through some of the formulas that I discussed last week that are very important. The first one was your gross profit percentage. So the first one was your gross profit percentage. The way you calculate it is you take your selling price minus your cost price divided by your selling price. Okay, so that's the way you calculate your gross profit percentage. So keep that in mind at any time in your business. If you want to calculate the gross profit on any product, all you do is use that formula, a really simple formula. So that's the formula, and you must remember that. The other formula that some of you have always been used to working with, which I do not like, is, so the formula that some of you have been using that I do not like is this one over here. I just want to put in a message here for somebody. Is markup percentage, and that's the formula for markup percentage. That's your selling price minus your cost price divided by your selling price. You'll see that the difference, there you're dividing by your selling price, here you're dividing by your cost price. Okay, so you can see the difference between markup and gross profit. They're very, very different. The other thing you need to remember, which is really key, is your break-even sales. How do you calculate your break-even? You take your fixed expenses and you divide by your gross profit percentage. So you take your fixed expenses, you divide by your gross profit percentage. That's how you calculate your break-even point. So let's use an example. Let's say my fixed expenses were $10,000 and my gross profit percentage was 50%. I would take 10,000, I would divide by 50%, and that'll give me $20,000. I'm going to show you a couple of examples now. When it comes to a service business, and a lot of you are in the service business, the way you calculate your break-even is you take your fixed expenses, you divide by your hourly rate. Okay, so your break-even for a service is your fixed expenses divided by your hourly rate. So I'm going to show you a couple of examples because I can see that somebody didn't understand what I said. So I'm going to show you a couple of examples of how you can do this. So let me show you an example, just so then I don't have to explain it. So let me just share my desktop with you first. I'm going to share my desktop with you, and I'm going to show you an example, okay? All right, so I want you to concentrate now. It's really important that you concentrate. So let's say, for example, this is my business. So this is my business. I run a retail type business, okay? Let's say my fixed expenses every month are $12,395, and that amount is all these things added up, okay? So I've added up all those things, okay? So those are all those numbers added up, and that'll give me $12,395, okay? If my gross profit percentage is 50%, I will take $12,395. I will divide by 50%, okay, and that'll give me my break-even sales of $24,790. So there's an example. $12,000 is my fixed expenses. My gross profit margin is 50%. My break-even will be $24,790. If my average customer purchases $100, okay, if my average customer purchases $100, then I need to get 248 customers to break even, okay? So let me go through that example again. So I added up all my expenses for the month. I added up all my expenses for the month. There you go. And that gave $12,395. I divide by 50%, 50%. Okay, and my break-even will be $24,790. Okay, let's say my gross profit was 20%. Okay, I would take my fixed expenses, I would divide by my gross profit percentage of 20%. That'll give me $61,000. If my gross profit is 30%, I will divide my fixed expenses by 30%, and it'll give me my break-even. Okay. If my gross profit is 80%, I'll take my fixed expenses, I'll divide by 80%, and that'll give me my break even. Okay, so that's the way you do it. So just like that formula I showed you early on, that's the formula. Monthly fixed expenses divided by my gross profit percentage will give you a break-even revenue. Okay? Just remember, when you divide by a percentage, if you're using a calculator, 80% will be 0.8. 50% will be 0.5. But if you do it on a computer like this, it will work it out automatically. There you go. So let's say my break-even was my gross profit was 60%. I'll take my fixed expenses, divide by 60%, and that'll give me my break-even revenue. It's really not too complicated to work. But I encourage you to use the templates. Use the templates because they've been calculated or they've been set up just for you. So you don't even have to understand the formula. I just put on the slides just in case some of you really want to understand the formulas, and I'll put that there. So let me give you another example. Let's say I'm a service business. So I'm a service business. I do exactly the same thing. I'd add up all my fixed expenses, and you would put your own in here, obviously. So that's $13,895. There you go. So $13,895. Let's say my hourly rate is $100 an hour. Okay. So that's my hourly rate. That's how many hours I need to sell every month to break even. Okay. So my break even in sales is $13,895. If I cover that, I've broken even, and that'll give me 139 hours. So that's the way you work it out. It's really not too complicated. Just remember, if you're a service business, you calculate your break even by dividing by your hourly rate. Or if you say you were doing, like we have the cooking lessons. Say I was doing cooking lessons, and I believe we have somebody on the course doing cooking lessons. This is how you'd calculate. You'd say cooking lessons are going to be $60 per person. There you go. I've got to make sure that I sell 232. Let's say I was doing a course of 4 cooking lessons. So or let's say a course of 6 people. So 6 people, and that'll be $360. Okay, I have to have 39 groups of 6 people, and I'll break even. There you go. So that's the way you calculate it. And remember, you can change these formulas. And if you're not sure, all you do is you email it to me, and I will fix it up for you, because I've been doing this for a while. I should know it by now. So keep that in mind. Don't be afraid to send me your calculation and say, I'm not sure exactly how it works, and then I'll show you, but you've got to send me numbers. You can't just do that. Let me show you another interesting template that I'm going to show you, yeah? I want to show you the difference so you understand the difference between markup. Let's use an example. Let's say, actually one of the fashion people said to us that they add on markup onto their product, okay? And let's use that example. Let's say my markup is 260%. This will tell you exactly what the gross profit margin is. There you go. If your markup is 300%, it calculates what the gross margin is. If your markup is 400%, even though I don't like using markup, you know, for some of you, you're so used to using markup. So if you want to, there's a formula. It shows you, given the markup, what the gross profit is. You'll see 300% markup is 75% gross profit. 100% markup is 50% gross profit. 50% markup is 33% gross profit. You see? So if any of you want this little template, you can just send me an email and I'll send it to you if you want to calculate the difference between markup and gross profit. But remember, you can only calculate your break even. And remember this, do not forget. You can only calculate your break even when you know what your gross profit is. So to calculate your break even, you take your fixed expenses. So that's how you do it. You take your fixed expenses, like I did over here, and you divide by the gross profit percentage. So your fixed expenses divided by the gross profit percentage, that's what you're going to be doing. That's the right way to do it. Does anybody got any questions? If you got any questions, just type it into the chat column, and I'll answer it for you, okay? And remember, I'm going to send you a recording of this. So if you want to go through this slowly and understand it, you're welcome to do that, okay? So you can go through it slowly, and you'll be able to understand it. Let me just share. I just want to share the phone number with a couple of people. Next time, I'm going to give you guys very, very clear instructions on how to join a webinar. I assume that everybody would have worked this out for themselves, but obviously some of you didn't work it out yourselves. Let me just share this with who was it else that I saw here that hasn't got in? Michael. Let's just share it with Michael, yeah. Let me see if I can find Michael. Yeah, I just want to share it with Michael, yeah. There you go. All right, so just remember, if you dial in, it's toll-free, so you can just dial in. All right, so let me just summarize quickly. Your gross profit percentage is your selling price minus your cost price divided by your selling price. Your markup percentage is your selling price minus your cost price divided by your cost price. There should be a bracket over there, okay? Your break-even sales, if you want to calculate your break-even sales, if you're a retail type business and you know what your gross profit margin is, you take your fixed expenses, like I've done over here, your fixed expenses, and you divide by your gross profit percentage, okay? So you take your fixed expenses and you divide by your gross profit percentage. Really not too complicated, okay? All right, when it comes to a service, you take your fixed expenses and you divide by your hourly rate. That's what you do. You take your fixed expenses and you divide by your hourly rate, and then you can calculate what your break-even is. So really quite simple. All right, so now we're going to go on to the other topic that we discussed, which is your legal stuff. So I'm going to show you how to do your legal stuff. It's really not too complicated, and all of you can, if you've got any questions, just put in the chat column. Just remember that on the right-hand side of your screen, just put in your chat column, and then I will be able to answer your questions. Okay, to see the chat column on the top right-hand side of your screen, so you'll see on the top right-hand side of your screen, you'll see a little chat icon. Just click on that, and it opens up a panel. All right, wonderful. So let's go through the legal stuff. Now, this section is really important, and I want you to understand this. And remember, if you've got any questions, you can just ask me. So just, if you've got any questions, just ask me, and you ask me by typing it in. So just type it in, and you can ask me questions. That's the way you can do it, okay? It's really not difficult to do. Just type in the question in the chat column, and then I will answer your question. All right, so let's go through some of the legal stuff. The first thing I recommend to all of you, and I think this is really key, doesn't matter what stage your business is at, you need to get legal advice. Ideally, in your first meeting, you want to get an appointment with a lawyer and you want to ask a bunch of questions. That's ideally what you want to be doing. But the more complicated your business is, the more complicated it's going to be. So if you have, for example, partners, if you have unique contracts, or if you have anything like that, I recommend you get a lawyer from the beginning. But for some of you, it's really good advice. The majority of you on the program, most of your stuff is really not that complicated. Because your stuff is not that complicated, you probably won't need legal advice. And if you need a couple of contracts and things like that, I'm going to show you a link that you can use. It's a site that you can go to. And when you go there, you can get free information. Okay? So I'm going to show you how to do that, and you can check it out. You can either get it free or pay $10 a month and get all the contracts in the world that you need. And it looks quite useful. I haven't used it, but it looked quite interesting, which is something you've got to do. So the first thing you've got to do is you've got to decide what structure you're going to have. So there's a couple of things. You can either operate as a sole proprietor, you can either operate as a corporation, or you can operate as a partnership, okay? So you can operate as a partnership. So Ashley's asked me a question here. Did you say we should all get a lawyer from the beginning? No, I never said that, Ashley. I said if your business is a little bit complicated, for example, if you've got a partner, Ashley, so if you've got a partner in the business with you, maybe it's a good idea to get a lawyer. But you don't have to get a lawyer. I'm going to show you how you can use other resources. Also, you can get a free appointment with a lawyer, which is not too complicated. You can get a free appointment with a lawyer, and they can help you through the basics. But really, it depends on you. It depends on how comfortable you are. And if you're not sure, I would recommend you make an appointment and then you can get a lawyer, okay? But also the City of Toronto has a program. You've got to concentrate. The City of Toronto has a program where you can sit in on a Friday afternoon and you can ask a lawyer a bunch of questions, okay? So keep that in mind. If you've got a few questions, you can always ask a lawyer. But again, the more complicated your business, the bigger your business, the more legal advice you get. So if you're not sure, I would recommend you get legal advice. But the majority of you probably don't need it. You can set it up yourself. I know, for example, when I started BizLaunch 13 years ago, I did not get any legal advice. But again, it was a simple business. I started off as a sole proprietor. Later on, when I incorporated, then I got legal advice. So if you're going to incorporate, it may pay you to get some legal advice. All right, so let us go through the different structures that you have. So we have different structures. The first one is a sole proprietor. So sole proprietor is the way the majority of people start their own businesses. Okay, so the majority of people will start off as a sole proprietor, and that's okay. And remember that you can change from being a sole proprietor to a corporation. So you can change from being a sole proprietor to a corporation. It's really not that complicated. If you've got a very simple structure, let's say you're the only owner, there's not too many liability issues, or you can get insurance for that. You know, operating as a sole proprietor is fine. And a lot of people do it, and it's really quite simple. Some of the advantages is that it's simple to set up. It's really easy. You just go online, spend $60, and you can register your business immediately. The other part about a sole proprietor that I like is that the financials are very, very simple. So at the end of the year, you can do your own financials. You don't have to pay somebody to do it. I normally do not recommend anybody do their own financial statements. That's my advice to you. But what I'm saying is, if you're a sole proprietor, you can do it. So you can either do it yourself, or you can get a bookkeeper to do it, which is not that complicated. But I still recommend you get yourself an accountant. The other thing is you can operate under your name. So really, you don't even have to register. If you think you're going to do less than $30,000 a year, you don't even have to register. You can just invoice people under your personal name, and you can do that. It's really not complicated. And anybody can sell anything. That's why people can sell on Kijiji. They can start Facebook groups. They can sell on Facebook. They can sell on Shopify, because it's legal in Canada. As long as you pay your income taxes, the government doesn't care. And there are a couple of tax advantages. So let me explain to you. Let's say you're working for a boss at the moment. Okay, so you're working for a boss at the moment, and you're going to start a business. What often happens in the beginning stages of a business, we have quite a lot of expenses. We have things that we spend money on. So let's say I've started my business this year, and I've incurred expenses of $10,000, okay? But in my job, I earned $30,000, okay? So I earned $30,000. So the big advantage that I have is that I tell my accountant at the end of the year that I earned income as working for a boss, plus I had expenses in my personal business. And what they'll do is they will calculate it for you, and it'll reduce your tax liability. So that's one of the big advantages, okay? So that's one of the big advantages of being a sole proprietor. Really quite simple. For some of you, it doesn't really benefit you because you haven't started your business yet. But if you've started your business while you're still working and you've made a loss, you can use that. Okay, so you can use that to benefit you and save money. So keep that in mind. So keep that in mind, that's one of the benefits. So the second thing are the disadvantages. There are some advantages and there are disadvantages. Okay, so this is really key. Advantages and disadvantages. Let's look at the disadvantages. And this is what everybody's afraid of. So if you speak to anybody that's got some legal experience or experienced business owners, they will say things like, the problem with the sole proprietor is that there's no limit to your liability. So if you're operating your business as a sole proprietor and I sue you, I can take all your business assets and I can take all your personal assets. Understand? And that is the reason that some people will tell you that you should rather incorporate. And they're right. If you've got a lot of personal assets, you're afraid you're going to be sued. Let's say you own a house or you own a Ferrari or something like that. I don't know what you guys own, but let's say you owned a Ferrari and you don't want to lose it. It probably pays you to incorporate. Okay, so there's no limit to your liability. The other thing is, which is quite a big thing, is that your business terminates when you die. So let's say you've built this great business, you've built a great brand, you've got your family involved in the business, but you're operating as a sole proprietor. If you die, the business dies with you. So from a succession planning thing or a family planning thing, that's a bit of an issue. The other thing is that the banks do not like financing sole proprietors. Okay? They do not like financing sole proprietors, so they will probably encourage you to incorporate. Also, if you want to get investors, no investor is going to invest money in a sole proprietor. So just keep that in mind. The other disadvantage, and I'm going to explain this in more detail to you a little bit later on, is that you are taxed as an individual, which is a big problem because our tax rates in this country are very high for individuals. So you could be paying 42 cents on every dollar for this, which is quite an issue. So just be aware of that, okay? You could be paying a lot of money on your taxes if you were sole proprietor. That is the key thing. And the other part that a lot of people say to me, and I can relate to this, is that they get really lonely operating their business on their own, okay? So this is why, as a business owner, often people will get partners. And the reason they will get partners is because they don't want to run it on their own. And so for some of you, it absolutely makes sense. Not for all of you, but for some of you, it's absolutely going to make sense. So keep that in mind. There are some advantages of being a sole proprietor, but they're minimal. So if I had assets, or I suppose I do have a few assets, then I'd rather pay you to incorporate. But remember, all of you can start off as a sole proprietor, and you can change later if you want to. You don't have to. You can operate as a sole proprietor for the rest of your life if you want. Just operate out of your own home or use somebody else's premises, and there's no issue. All right. Then there's a partnership. So let's say two people get together, and they decide, you know what? We don't want to spend money incorporating and doing all that expensive stuff. What we're going to be doing is we're just going to partner. The problem with partnerships are a couple of issues that I'm going to be discussing, but the advantages are really quite simple, is that a partnership is really easy to set up. You can go online this evening, you can set up a partnership straight away. Or you can contact Revenue Canada and say, I want to set up a partnership, and it's really quite easy. The big advantage of a partnership is that you can have complementary skills. So let's say, for example, you're good at the financials, I'm good at the marketing. That would be a great relationship. So that's some of the advantages of partnerships. And also, let's say, for example, you're in a partnership with somebody and you decide you don't want to be a partner with this person anymore. The termination of the business is very, very simple. You just close the business down, contact Revenue Canada first. You just close the business down, and it's done. Really not complicated at all. Okay, so that's a partnership. This is what I recommend to people. I recommend that if you are going into a partnership, if you're going into a business with somebody else, with another one or two people, I don't recommend you do a partnership. I recommend you incorporate from the beginning. That's my advice to you. But let's say you're a little bit low on money and you don't want to incorporate from the beginning, you can do that. You operate as a partnership for a while. Once you make more money, you can then incorporate. Really not that complicated, okay? So it's really quite simple. What are the disadvantages of a partnership? The one thing is that you are jointly and severally liable for the debts. So let me give you a very good example. Let's say you and I are partners in a business. You're very wealthy and I'm poor. If I owe somebody money, they've got a couple of options. They can either sue me, or they can sue my partner, or they can sue the two of us. Okay, so that's one of the disadvantages, is that the wealthier partner could be sued. So that's one of the things that lawyers will tell you is the disadvantage of a partnership, is that the liabilities of the corporation, of the partnership, or the debts of the partnership are yours and your partner's, both jointly and severally, which is as individuals. So that's a really key thing. The other thing that I found, and I've seen this so many times over the years, is that partners will always argue. So I recommend that that you be aware of that, is that often there'll be disputes between partners. You need to be aware of that and take this into consideration. So there will be disputes. So think about that. In advance, think about, if we're going to be arguing, if we're going to have disagreements, how are we going to deal with it? The other problem you've got is if one of the partners dies. Let's say, for example, you and I are partners. I walk out onto the highway, a bus hits me. You know what? The partnership is gone. So that's one of the disadvantages of a partnership. There's no continuity, which is quite a big issue, especially if you've built a brand, especially if you've got assets in the business. This could be a major headache. And the other disadvantages are the tax disadvantages. We're both partners or taxed as individuals. Doesn't matter that we're partners, doesn't matter how much money we make, we tax as individuals, and the tax rates are really high. So keep that in mind and be aware of that. That's the disadvantage of a regular partnership. And maybe you've heard of people that have a regular partnership. All right, so let's move on to the next structure, is a corporation. Now, the majority of legal people are going to tell you that a corporation is a good idea. And let me tell you why they say it. There are two reasons. One is that a corporation is a separate legal entity. So that's one of the big advantages. It's separate from you. So legally, you can even sue your own corporation. Even though if you own the 100% of the corporation, you could sue your own corporation because it's a total separate legal entity. The big advantage of that is that it limits your liability. So they cannot take your house, they cannot take your car, they cannot take any of your assets, as long as they are very clear that they are doing business with your corporation and not with you. So just make sure that you understand that if you invoice somebody, it's with your corporation's name. If you use a business number, it's your business corporation's business number, not your personal business number. Okay, so just be aware of that. The other advantage of a corporation, and this is a really important one, is that shares are easily transferable. Okay, so let's say I start a corporation. And I issue 100 shares at $1 each. So I decide that's the price I'm going to give the shares. I pay $100 into the corporation's bank account. What I can then do is, say after a while my business is growing, it's doing quite well, and I meet somebody that wants to buy shares in my corporation, well, I can sell them some of those shares. I can sell them some of those 100 shares I've got. Maybe I'd sell them 5 or 10 or 20 or 30 or 40, whatever it is. I would value the business. I would value the market value of those shares, and then I could sell to them. So those are some of the big advantages of being incorporated. So if any of you are thinking of raising money from investors or angel investors or venture capitalists, this is a big advantage. Okay, so this is a big advantage because then you can transfer shares. The other advantage is there's continuity. So the big advantage here is that the business never dies. You can die, but the business never dies. Okay, so that's a key thing. One of the questions Michelle's got here, do you always have to keep the price of a share in your bank account, if not sold? Oh, okay, yeah, you should leave that $100. So say you bought 100 shares, say you started your corporation and you bought 100 shares of $1, ideally you should keep that in your corporation. Don't touch that money. So it's in your bank account, or it can be even in a, I just put it into my regular bank account and I ignored it for the rest of my life. That's what I did. But it always stays there. It's $100. So on your balance sheet, you'll have share capital or $100. Okay, simple. Your share capital is $100, and that's what you leave it at. You don't change that. The only time that value will be changed is when you sell those shares. So when you sell shares to somebody, you'll sell them at market value. You won't sell them at $1 once you're doing $1 million. Anyway, so there's continuity, which is quite an important thing. If you die, the business doesn't die. So the big advantage is really anybody, your friends, your family, your neighbor, anybody can inherit your shares. Obviously, you've got to put it into your will. But let's say, for example, you've got a few staff that you really like, and you say, you know what, one day when I die, I leave it all to you. You could do that if you're a corporation. So that's one of the big advantages of incorporating, is that people can inherit your shares. Your family, your kids, all those people can inherit your shares. There are some tax advantages, which I'm going to explain to you later on, but it's really key that you understand that you understand that the two reasons that people will incorporate, one is that it limits their liability, and the second one are the tax advantages. Okay, so those are the two reasons people will do it. But the reality is that if you're not making profit, and if you don't have any assets, it doesn't make sense. But if you have assets and you believe you're going to have a successful business, it really pays you to incorporate. Okay? So think about that, and you make a decision. You can ask me, maybe if you want to send me a bunch of questions, or we can discuss it one-on-one, but really it depends on your situation. There's no right or wrong. A lot of people start off as sole proprietors, and they're really happy, and they never change. You make a decision. The other thing that is something you need to think about is the perception in marketing. So just be aware of that. Because when you're selling to large corporations, for example, if you're a sole proprietor, sometimes they don't even know how to do business with sole proprietors. Because their taxes, the accounting system doesn't typically deal with sole proprietors. So when it comes to doing business, the fact that you're incorporated may create a better image. It doesn't guarantee that, but again, it's just about perceptions. So let's go through the key advantages here. The key advantages are, it's a separate legal entity. The other advantage is, the shares are easily transferable. If you die, the business lives. It will not die. Your family can inherit shares, or anybody else that you know, and there are some tax advantages. So these are the key benefits of a corporation. The disadvantages, there are some disadvantages too. It's more expensive to set up. And let me just say this to you. If it is your plan in the future to raise money from investors or angel investors or anything like that, this is my advice to you, is go to a lawyer and incorporate from the beginning. This is what I recommend you do, okay? Because then they'll set up the right share structure for you. They will put everything in place. Otherwise, if you do it yourself, you're going to have to go back and change it all. So if your plan is to get investors, if your plan is to sell shares to other people, I recommend you go to a lawyer from the beginning. That's my advice to you. The other thing is that as soon as you incorporate, the law requires a greater disclosure. So there are certain things that the law requires. It requires that you submit an income statement at the end of the year. It requires that you submit a balance sheet at the end of the year. It requires that you use accounting software to store your information. That's the law. And also, your accountant's going to charge you more. So an accountant will charge between about $1,500 and $2,500 to do your accounting. So keep that in mind and be aware of that. So that's one of the things that might deter you from incorporating. It's going to cost you money. It's more expensive to set up. And even if you don't make any profit, your accountant could still charge you $500 to do your accounts, because that's their standard fee for a corporation that's not operating whatever. They have these crazy fees, so just be aware of that. And then you'll require some income tax advice, and this is really important. Once you incorporate, I would recommend you regularly meet with your accountant. Regularly meet with your accountant to discuss how you can pay less tax, because that's really what we want. All of us want to pay less tax, or we want to pay a fair amount of tax, and your accountant can help you either delay the payment of tax or pay less legally, and that is the key thing. You don't want to do illegal things. So that's a corporation. Now, let me give you some really important guidelines. This is really, really important. And this worked really well for me. When I partnered with Roger, what we did is we went to a lawyer and we created a very solid agreement, and it really worked in my favor. So I'm going to encourage you is if you've got a very profitable business, or you think, because nobody knows, but if you think you're going to build a very profitable business and you have partners, this is what I recommend you do. On a piece of paper, with your own piece of paper and your own pen, or on your computer ideally, what you do is you write down exactly what each partner is going to put into the business. Okay, so let's say, for example, I'm going to put in $50,000. Let's say you're going to put in I don't know what you can put in. You can put in a trademark or a patent or whatever it is. We write that down. That's the first thing. The second thing is we write down each partner's responsibilities. And I recommend you do this. This is really good advice, that you write down exactly what each person is going to do. So there's no confusion here. No confusion. You're going to do the marketing. I'm going to do the sales. I'm going to play golf 3 times a week. You're going to work 24 hours, whatever. You write these things down. It's very important that you write everything down. The third thing, which is really important, is how you're going to divide the profits and the losses. Because you've got to understand, businesses don't always make losses. So the problem you've got is, let's say the business needs more money. Let's say the business needs more money to grow. And I want to take all the money out because I want to buy a new holiday home. And you decide you don't want to take all the money out because you want to grow the business. That is really a key thing that could become a big disagreement. So I encourage you to discuss this. You might say, for example, at the end of every year, we will pay out 10% dividends on the profits. Or you may say, we will pay out no dividends for the first 5 years. Or you might say, we'll pay out all the profits as dividends, whatever. Or you might say, we will have a meeting, we will discuss it, come to an agreement, and we'll pay out a certain amount of dividends. So it's really key that you think about this in advance. Don't wait till you make money. I always say to business owners that while you don't make money, nobody fights. As soon as there's money, people get stupid, and then they start arguing. So make sure you address this. All right, the other thing you want to discuss is how much salary each partner will earn. So there are a couple of ways you can do this, and I'll give you a couple of models that we've used over the years. You can either both get a fixed salary, which may be a little bit difficult in the beginning. It may be a little bit difficult in the beginning to get a fixed salary. And the reason is because the business is growing. So what you might do, which is exactly what we did in BizLaunch, is we took a percentage of the revenue. So we took a percentage of the revenue on condition it was paid by the customer. So basically, if a customer paid us, we took a percentage of that, and that's what our salary was. And it worked really well, because when there was no money, we didn't take any. When there was money, we took money out. So that was a good decision, and you can use exactly the same thing. But again, you must discuss it with your partner or partners in advance. The other thing is, if there's a dispute, let's say you and I are partners, we have a big argument, we can't work it out. In this agreement, we will write down exactly how we're going to solve that problem. So we might say this. We might say, if there's a dispute, we will meet with George, the accountant, or Sarah, the lawyer, and she will mediate for us. So I recommend you put this in your agreement. That is exactly what we did when Roger and I partnered. We put in our agreement, and it was brilliant for us, because when there were issues that we couldn't agree upon, we'd go to a mediator and we'd solve it. And so we addressed the issue before we did it. Also, if your partnership is going to be sold, so let's say your corporation, if your corporation is going to be sold or you're going to dissolve it, the key thing is, how are you going to value the business? So it's a really good idea in your partnership agreement with your partners in a corporation, or your shareholders, you should actually use not the word partners. You should write in the agreement exactly how you're going to value the business. Or you can write in there who you're going to go to value the business. So there's a combination of ways you can do it. Either you can put in a formula into the agreement, or you can recommend you go and speak to somebody that will value the business. So there's a combination of ways that you do it. And I encourage you to do this in the beginning, before you make any money. Don't wait till later on. Say, you know what, as soon as we have time, don't worry, we'll sort that out later on. Don't do that. Do it up front. And this is what happened to me, and it worked brilliantly in my favor. Even Rogers, where it was all sorted out, we didn't spend money on lawyers because we had the agreement. I mean, you always spend money on lawyers, but we would have spent much more if we didn't have agreement. So I recommend you do that. Take that advice. It's worth a lot of money, and it's free. I encourage you to do that. So when it comes to your taxes, so there are a couple of things you need to register for. When you register your business, they will give you a business number, which is key. You've got to understand that. You need a business number. You need a business number to open your bank account. You need a business number to pay payroll. You need a business number for a bunch of things. Okay? There are different variations of the same number. But it's almost like an identity number for your business. That's really what it is. So if you think you're going to do more than $30,000 of revenue a year, you have to register for HST. That's the law. But even if you think you're going to get close, I recommend you register for HST. And the reason is that if you go over the number, I had a very good example of a small business owner last year. She thought she hadn't registered for HST. But you know, when they ask you all these questions, she clicked the HST button. Come the end of the year, Revenue Canada phones her up and says, listen, you haven't done your HST return. She said, well, I did not do $30,000 of revenue. They said, we know you, or it doesn't matter whether you did $30,000 of revenue, you registered for HST, you've got to pay HST. She said, but I didn't charge my customers HST. They said, that's not our problem. So just be very careful of that. If you register for HST, even if you don't do $30,000 of revenue, you have to charge people HST. You are not allowed to charge HST. You are not allowed to charge HST if you do not have an HST number. Okay, so keep that in mind. There are certain services that do not charge HST, certain educational services and things like that. Go online and check that. Or phone Revenue Canada. Phone Revenue Canada and say, listen, I want to know if my type of business, you charge HST. For example, if you offer piano lessons or something like that, you don't charge HST. But otherwise, everybody charges HST. If you sell internationally, if you're selling to the US, or if you're selling to Europe, or you're selling to Africa, or you're selling to anywhere else, you do not charge HST. You cannot charge people out of the country HST, so don't charge them HST. The other thing you have to do is if you employ people, you have to charge for, if you employ people, you don't have to charge. You have to take off payroll taxes, and you have to pay EI, which is employment insurance, and Canada Pension Plan. So just be aware of that. It's not difficult to calculate. You can use a payroll service, or you can just go online to the government's website, okay? You can go onto the government's website, and you can do that, okay? So it's not too complicated. Right. So this is for employees. This is only for employees. If you are employing somebody as an employee, you make sure that you register payroll. So one of the questions you have from Tina, even if you're making over $30,000, you cannot charge other countries HST. That's correct, Tina. You cannot charge anybody out of Canada HST. Or you can do whatever you like, but it's illegal. I mean, do whatever you want to do, you can do, but it's illegal to charge them HST, okay? Anybody out of Ontario and anybody out of Canada, you cannot charge them HST. So keep that in mind. All right, so then you should check. If you're working with machinery and stuff like that, you may have to register for WSIB, okay? So a lot of businesses do this, but I would recommend you call them first. The majority of your businesses, let me just think. Yeah, the majority of businesses will not have to register for WSIB, but I would still check. I would just phone them up and say, hi, this is what I'm doing, and should I register for WSIB? And I know we've checked with them for our business, so we didn't have to do that. All right, so the next one is insurance. Let me just say something to you. You can buy insurance for anything. You can buy insurance for anything. The decision you've got to make as a business owner is it worth me buying insurance? Right, so let's first speak about liability insurance. Somebody comes into your premises, slips and falls and knocks their head. There are a couple of issues here. Number one is, if your landlord has this insurance, you don't have to buy it. But often the landlord is going to make you buy it. So that's one of the decisions you got to look at. Also, if you're operating your business from home and you're getting clients coming to your home, just be very careful, because your personal home insurance does not cover that, okay? But remember, if you're not getting people from home, if people are not visiting your home, and if people are not coming to your premises, you don't need that type of insurance. So don't worry about that. Then there's a thing called errors and omissions insurance. This is what consultants get. So let's say, for example, I was a tax advisor. So I was a tax advisor, and I was giving people advice on taxes, or if I was telling them how to grow their businesses, very specific information. Then it pays me to take out insurance. But just remember, it's called errors and omissions insurance. It can be very, very expensive. So when small business owners ask me, should I take out errors and omissions insurance? I usually say, it's up to you. It's really up to you. I do not have errors and omissions insurance. And the reason is that I'm giving general advice. I will always say to people, you know what, this is just general advice, even in my slides, all that type, not in my slides, in my books and things like that. I will say to people, this is just general advice. You got to go to an expert. So just remember that. Even if you give people advice, if it's general advice, you've got to decide whether you want insurance or not. I do not have insurance. The only time we ever had insurance in BizLaunch was a few years ago. One of our clients, Visa, asked us to get insurance just in case somebody sued them because they told them to calculate the break-even by dividing by gross profit. Whatever, I don't know. We developed content for them, put on their site, and they were concerned about that. But realistically, whenever you work with a client, you can make them sign a document saying that, you know what, this is general information and we're not liable. As long as it's reasonable, nobody's going to sue you. The other thing I want you to remember, typically, Canadians do not sue that often. That doesn't mean you're not going to meet somebody that wants to sue you. So I'm just giving you generalized advice, and that's what you can do, okay? So it's really not that complicated. All right, I'll speak about templates now for waivers, so you could have a waiver. Other legal requirements. Let's say you're not sure if you need to get any permits or licensing. There's a government website that they've created called bizpal.ca, and what you do is you go on there, you click on what province you are, and they will tell you exactly what permits and licensing you need, okay? So make sure that you check. Whatever city you're working in, sometimes it's a little bit different. Not always, but sometimes it's a little bit different in different cities. So just check what the regulations are. And this website is quite good, so check that out. All right, so now I'm going to discuss another issue, and this is quite a key thing. The majority of you are going to probably operate your business from home. But if you are living in a residential area, now you've got to concentrate when I'm telling you this. If you are living in a residential area, that is not a business area. That is a residential area. So, according to your local city hall, in your case, Toronto, you should only operate a business in a business area. But they're not going to stop you from operating your business from home. Okay, so if you're operating out of your basement, and nobody's going to stop you from doing it. Even though it's not legal, they're not going to stop you from doing it. But, let me warn you, if your neighbors complain, let's say 4 or 5 neighbors in your area start complaining to the city, they say, you know what, Sarah's operating her business from home, she's consulting with clients, and they're coming in regularly, and it's disrupting our neighborhood. they could go to the city, and the city could stop you from working from home, just so you understand that. So even though it's not legal, the city's not going to stop you. The only time they will stop you is if your neighbors complain. If you understand that, you'll be okay. So this is my advice to you. Don't make noise. Don't generate excess traffic. Make friends with your neighbors, and you can operate your business for the rest of your life at home, and nobody will bug you. The only time they will bug you is when you irritate them. So keep that in mind. So go and check the legal requirements for this. You can go and check it out. Most of you probably won't have anything, but just check it anyway. I'd encourage you to check it. I don't want you to come back to me later on and say, I didn't know about this or I didn't know about that. That is mainly for food type of businesses and things like it. But check it anyway. Just go online, check it, and see what it is, and that's going to really help you. All right, so earlier on I was speaking about payroll. I was saying to you that you can go online, and there's a payroll calculator. So here it is. You just Google Canada Revenue Agency payroll calculator, and it'll tell you how to do it. Actually, you can create pay slips directly from this. So you put in the employee's name. That's the first thing, employee's name. You put in the employer's name. You put in the province you're in. You put in the pay period, if you pay the monthly or bi-weekly, whatever it is. You put in the date, and it'll calculate how much CPP you're going to pay. It'll calculate how much EI you're going to pay, and it'll calculate how much income tax you're going to deduct from the salary. Okay? So just check it out. Just go to Google, type in Canada Revenue Agency salary calculator, and you can do that. It's really simple, not difficult to do. Any one of you can do this. So, and I encourage you to go and check this out. It's simple, easy to do, and it's a wonderful little tool. Okay, so check that out. All right, so now, one of the things that you also want to check are trademarks. So let me just explain to you, just basically, because I want you to go and Google this. There's the link. I'm going to send you these slides because these are updated slides. So I'm going to send you a recording of this webinar, and I'm going to send you these slides too. So you can get a trademark on a letter, on a word, on a sound, on a design. You can get a trademark. So you'll see this often. You'll see like Coca-Cola, and they have a little TM on the top right-hand corner. So in the case of BizLaunch, for example, I've got a trademark for BizLaunch. I've got a trademark for BizLaunch across Canada. So nobody else can use that name. Or if they do, I can write them a letter and say, hi. Probably I wouldn't be so polite, but using my trademark, you're not allowed to do that. So in Canada, trademarks are valid for 15 years. Okay, so that's how long a trademark is valid for. And I encourage you, any of you that are interested in trademarking, maybe your business name, maybe your logo, maybe your, I don't know, whatever you want to trademark, I encourage you to go and watch this video, and it'll explain to you all the regulations around a trademark. Okay, so keep that in mind. Check it out. For some of you, it may be the answer, and it really depends on how you want to grow your business. The biggest problem with a lot of small business owners, we want to get trademarks, we want to do these things, we don't always have the money. Otherwise, we would have done it. So I registered a trademark for BizLaunch, and the reason I did this is I really liked the name. I really liked the name, so I thought, let me protect it across Canada. And the other reason was we were doing BizLaunch seminars, we were working with Staples and Visa, and I really wanted to protect the name. So that's the way I took a trademark out, okay? And it's valid for 15 years. So I have to renew it before the 15 years is up. Right, then we've got patents. Oh, wait, before we do that, if you want to check if there's a trademark, you just go to the trademark database. You just type in what your trademark is, what name you're looking for, and you can go and check it out. So do a trademark search. Also, what you should do, but not all of you are going to listen to me, is you should use a trademark agent to register your trademark. I didn't do that. I did my own trademark, but I don't think it was clever. In hindsight, I should have probably got a agent to do it, and they would have probably done it better than I did. But anyway, I don't worry about it, and it hasn't had an impact on me, and I've had the trademark maybe 10 or 11 years. I can't even remember, okay? So keep that in mind. You can search for trademarks. All right, so now we're going to discuss patents. And for those, some of you I know on the program already have a patent. What I would recommend is you go and check out this information about patents. It's again quite simple, but the reason people will take out patents is they want to protect their design, or they want to protect their technology, or they want to protect, that's what they want to be doing, okay? So that's the reason they will take out a patent. So I encourage you, if you think you've got a unique design, or if you think you've got something unique, you take out a patent. The other thing that I encourage you to do is, and this is the difficult part for small business, taking out the patent is not too expensive. Oh, it can be expensive, but again, depending on who you use and how technical it is, but it can be expensive. Protecting the patent is the difficult part. Okay, so that is the biggest challenge. So just be very, very careful of that. Is you've got to understand that that could be the expensive part. Is that when people infringe on your patent, you have to, or you don't have to, you can do whatever you want, but you should write them a letter saying, listen, that is my patent, you are infringing on my patent, and that's where it gets very expensive. But there are some big advantages. If you ever sell your business and you've got a patent, that could be worth a lot of money. On the government website, it says that a patent is valid for 20 years. Michelle's saying it's 16 years now. This is what the government website is. So just check that. When you're registering your patent, just check with your patent agent or your patent attorney how long it is. This is what the government website is, but maybe it hasn't been updated. I'm just saying what I read. But go and check it. It might be interesting for you as an educational thing. Go and check out. It's got a list of patents there. It's fascinating. The advantage is, and I know I was speaking to somebody actually this week. I was having coffee with somebody, and what they do is they look for expiring patents. And they found in a patent for a pharmaceutical product, and they're going to now produce it because the patent's expired. So there can be some advantages. There's some business opportunities there. But remember, if you own a patent, it can be really, really useful. As long as you can protect your patent, that's the expensive part. And this is why small business owners sometimes don't patent things, or sometimes investors say it's very expensive, and that's why people don't do it. But otherwise, if you can, I think it's a wonderful thing, okay? So if you can do it, I encourage you to register a patent and make sure you protect it. That's the key thing. So that's patents. All right, so the next thing is, let's say, for example, that you want, let's say, for example, that you want to get, let's say if you want to get a contract. So you want to get a contract. There's a website called ClauseHound. Let's say you want to get a, I don't know, you want to get a waiver, or you want to get a simple contract for somebody, you can go to ClauseHound. Okay, so ClauseHound is a site where you can get a whole lot of legal agreements. So it's a starter pack is free, and then this one costs $10 a month. So I encourage you to go and check it out. I've never bought from these people before, so I don't know how good or bad they are. I would probably start with the free version, and then I would upgrade if I needed to the paid version. So go and check it out. It's a Canadian company. It's based, I think, on Queen Street East or King Street East. I think that's where they're based, and it's for a whole lot of contracts. Go and check it out. So I found this for you. You go, after the seminar, you go and check it out, okay? So go and check out what ClauseHound is, and what I understand it to be is simple templates and simple contracts that you can use, okay? So go and check it out. That's what it is, okay? All right. So Sarah says, ClauseHound says, ClauseHound is good. My patent lawyer recommended. There you go. So I'm glad you've used it, because I had no idea if it was good or bad. So thank you for that, for helping us guide it. So go and check it out. After the class, after the webinar, go online and check it out. Just Google that and you'll find it like I found it. I found it really quickly. I just searched for it and I found it. All right. So anybody got any questions on the legal stuff? Any questions on that? If you've got any questions, just post them in the chat column while I take a sip of water. All right. So, and remember, this legal stuff, I mean, I took an hour or so to discuss this. Remember, it can get far more complicated. So just understand that. It can get far more complicated. The objective, was just to give you a basic overview of the things that you need. So remember this, that if you want more information, I recommend you get legal advice. So that's what I recommend you do, is that if you've got a complicated situation, you get legal advice. So Michelle's asked me a question. Remember, I recorded this webinar so you can listen to the whole thing again. But Michelle, what I said is, I met somebody this week that takes expired patents and they create the products. That's what I was saying to you. Okay, so it was just some business owner that I met that does that. They take expired patents and they create the products. All right, so now we're going to discuss taxes. And remember that, again, this is really, really key. So one of the questions Tamara's asked me, if someone who buys my shampoo has an allergy, so that's one of the reasons. So they've got two options, is either they could sue you or they could sue the company that made it originally. Okay, so keep that in mind. So if somebody's got an allergy and they buy your shampoo, the liability usually would fall on the original manufacturer. Okay, so just be aware of that. But the way you can protect yourself is tell people, when they buy it, that if they've got an allergy, they've just got to be very careful. Okay, so you'll have, like you see, medication does that. They say, if you buy this, just be aware if you've got an allergy that you could be allergic to it. Okay, so that's how you deal with that thing. Okay, but again, look at the way other companies are doing it and check it out. But basically, that's how it works. All right, so let's move on to taxes. And remember, if you think of any questions as I'm going through the other parts, in the chat column on the right-hand side, just post your questions, and I will try and answer it for you, okay? But you need to think about your situation, because every single one of us will be different. So every single one of us will be different, so it really depends on your situation. But you want to protect yourself as much as possible, but also don't overdo it, because that can get very expensive. You can pay more in insurance than the profit you make every month is something you've got to be careful of. Okay, so just be very, very careful of that. All right, so let's go through some of the income taxes. The first bit of advice I give all of you, the first bit of advice, which is really, really important, is get some tax advice. I encourage you to do this, is get some tax advice. Your accountant could save you a lot of money, so make sure that you get some tax advice, especially if you have some assets, especially when you think you're going to start making profit, and that's the key thing. The second thing is make sure that you set up systems to keep all your information organized. I can't tell you how many times over the years I've met business owners that struggle because they're not organized. Because if you ever get audited, or if your accountant wants some information, you need to have access to this information. So make sure you understand this. So get tax advice, use systems, do some tax planning. This is really, really key. You can save a lot of money if you plan in advance. You don't want to leave it too late, because then nobody can do anything about it. So make sure you plan in advance. Get organized, and remember how the tax system works. It's not complicated. The more you earn, the more you pay. That's how it works. And if you understand that concept, you'll be okay. So one of the objectives is you want to make sure that you only pay a fair share of your income taxes. I do not want you to overpay. Some people think they're being clever about putting in expenses, but they're still overpaying. I don't want you to be that person. So just be aware of that. All right. So when you get an accountant, this is really key. And some of you have heard me saying this before, but it's worth repeating. When you choose an accountant, make sure you get somebody that is reliable, that asks questions, that educates you, that you understand and that works with small business. So here's a really good question Ashley's asked me. What are my thoughts on using a bookkeeper versus an accountant? Okay, so in the beginning, Ashley, using a bookkeeper is okay. If your business is small and you're not making too much profit, using a bookkeeper is okay. But as your business starts expanding, it really makes sense to use an accountant. Because accountants, you want to use an accountant that understands taxes. So if you're operating as a sole proprietor, you can use a bookkeeper, no problem. As long as they understand a little bit about taxes, you have no problem. Because as long as they put through all the expenses in your business, you keep all the receipts, it's really quite simple. So Ashley, you decide. Do you want an accountant or do you want a bookkeeper? And for some of you, bookkeepers will be good enough. If you incorporate it, you have to use an accountant. So you want an accountant that asks questions? So Michael's asked a good question. I have an accountant. Do I need a bookkeeper? And the answer is, it depends. If you're doing your own bookkeeping or your accountant's doing it for you, you don't need a bookkeeper. So if you're using accounting software or you're very, very diligent and you collect information, you have no problem, okay? If you incorporate it, you have to use accounting software. So you either got to pay a bookkeeper to do it, or often your accountant will have bookkeepers that they use. So it really depends on you, Michael. If you can do it yourself, do it yourself, but otherwise employ a bookkeeper. I often recommend to people that are not maybe the most organized people in the world to get themselves an accountant. That's what I recommend. So here's some tips for you. I recommend you an accountant, get an accountant that asks questions. I recommend you get an accountant that educates you. I recommend you get an accountant that you understand. And I recommend that you get an accountant that works with small business. Ask other small business owners for a referral. That's what I recommend you do, okay? But it can really solve your problem. But just be very careful again. Just because somebody's a qualified accountant doesn't mean they're good. Some accountants are very disorganized. Some of them are, I don't know, you get all types. So just be very, very careful. I know I've dealt with them over the years and really struggled with some accountants. All right, so let me explain to you what you've got to do. Is that you've got to collect your information. So that's the key thing. And the way you collect your information typically is that we use accounting software. So there are three key ones that we use in Canada, and you can use any one of them. There's QuickBooks, there's Wave Accounting, and there's FreshBooks. Okay, so those are three that a lot of people use. You decide which one you want to use. But most accountants are going to recommend this. Okay, so most accountants will recommend QuickBooks. So maybe that's what you can use. You get your accountant to set it up for you, and then you can input the information. As long as you got the discipline, you can input the information into that. Okay, so that's what I recommend you do. Develop a good system of keeping your receipts and invoices. Make sure your records are organized. Use accounting software. And if you're one of these people that are very disorganized, get a bookkeeper. You can probably get a bookkeeper in Toronto for about $25 or $30. But remember, you could get an accountant anywhere. I'm in Windsor now. Maybe you could get a cheaper accountant in Windsor or Chatham or, I don't know, online. There's just so many options. As long as you trust the person, it really doesn't matter where the bookkeeper is. It's a very common thing nowadays to have a remote bookkeeper or a remote accountant. So it's a very, very common thing. So you decide what you're comfortable with. But if you're not the most organized person in the world, get yourself a part-time bookkeeper. Just to come in an hour or two a week, or you send them the information, and they work on it an hour or two a week, and then they get you organized. Okay, so that's what I recommend you do. All right, so let's go through the taxes. Now, I want you to understand, this is your objective. All reasonable business-related expenses are tax deductible. So just remember this. All reasonable business-related expenses are tax deductible. So your objective as a business owner is really quite simple, is to find all those reasonable deductible expenses and deduct them all. And my job is to try and educate you on what is reasonable. So I'm going to give you a couple of examples, and you've got to understand. But let me just say something to you, is that you've got to make sure that you collect the invoices. You collect the invoices, and you collect the receipts. That is your responsibility. So that's your responsibility, and you mustn't forget that. You cannot blame your accountant, or you can do whatever you want, but you cannot blame somebody else for not having information. So let me explain this to you in very simple English, as simple as I can explain. All reasonable business-related expenses are tax deductible, and this is the definition. An expense is a cost you incur for the sole purpose of generating income. Okay, so that's the objective. If you've made revenue, or if your intention was to generate revenue, then that is a business expense. Okay, so that's the key thing. If you generated revenue or you intended to make revenue, because sometimes we spend money when we don't make money, that's okay, as long as it's a business expense. The most important thing is that you support any business expense with evidence. Okay, so you've got to back it up. Revenue Canada is going to say to you, for example, they're going to say to you, last year, you said you spent $422 on stationery. Can we have evidence of all the receipts, if you've got receipts, or all the invoices? If you've got invoices, we want evidence of all of those. Then you've got to supply them with this evidence, and then they will decide whether that expense is allowed or not. So keep this in mind. It's your responsibility to keep invoices and receipts. It's your responsibility. You can't, well, you can blame whoever you want, but it's your responsibility. And the other thing is you've got to prove that you incurred the expense. So this is something really important. Every now and then I'll see business owners go out for dinner, and they take other people pay, and they take the receipt. Understand that is illegal. If you ever get audited, you've got to prove that there was a business meeting. So just understand that. And I just want you to be aware of this so you understand. All right, so let's move on. The next thing is, what are the expenses that are allowed? Any operating expenses, any rent, any telephone, any utilities, anything that you use that you can link to business is an operating expense. Travel is an operating expense. Your bookkeeper's operating expense. Your accountant's an expense. All of those things are expenses. Whatever you incur, so that list that I discussed whenever we're doing those exercises, all of those things. If you buy any samples, for your business, that's an expense. If you buy any inventory and you sell it, that becomes an expense. So all of those things are expenses, and they're legitimate expenses. Remember, inventory only becomes an expense when you've sold it, so just keep that in mind. If you haven't sold it, it's not an expense. All right, anybody got any questions on that? And you can type in the chat column. All right, no questions on that. Let's move on to the next line. The next line is local and international travel. So let me give you a very good example. I am always on business. Wherever I travel, anywhere in the world, I'm always on business. And I encourage you to do exactly the same thing now. From now on, whenever you travel, always make it a business trip. Let me give you an example. Let's say I wanted to go to England to go and visit the Queen. No, maybe not visit the Queen. Let's say I want to go to England to go and watch a sports game. Let's say I liked watching soccer, or I like watching rugby, or I like watching cricket, or let's say I want to go to the theater. I've always wanted to go to the theater in London, England, so I want to go to the theater. And I want to make it a business trip. Now, the first thing I've got to identify is, how do I make this thing a business trip? So in my case, I run seminars, I run training programs for small business owners. So ideally what I should do is I should go and meet up with people in London, England, that do exactly the same thing. So that's exactly what I'm going to do. I'll fly out from Toronto on Friday night. On Saturday, I arrive there. On Sunday, I unpack all my stuff in my hotel. And then I have a meeting on Monday morning. I can have a meeting with a customer or an expert or somebody that runs seminars on Monday morning. I can meet with them, say, at 10 a.m. in the morning. So what am I doing in London? I'm there on business. This is what I do. You don't have to do this, but this is what I recommend you do, is you keep evidence of that. So if you've got an email from the client, from this consultant, you keep an email from that. Another good idea is I recommend you take a photograph. Well, this is what I do. I will be, let's say I'm in London, go and visit a small business center. I'll take a photograph and I'll post it on Facebook. The reason I'll do that is because then I can prove I was there on business. So let's say Monday I'll meet with one client. On Tuesday, I decide I'm going to walk around and pick up some ideas. Maybe I'll walk up Oxford Street, up and down Oxford Street, do some window shopping, go into some of these stores, look at the way they're merchandising things, maybe take a couple of photos, some ideas for my training seminars when I get back to Canada. So that's what I can do. Let's say on Wednesday, I go to the theater, Wednesday night. If I'm going on my own to the theater, I shouldn't put that through as an expense, okay? I wouldn't recommend you do it. If you're taking a client out to the theater with you, then it's a different situation, okay? Because then that's entertainment. So you can put that through your business. But just be very careful. If it's personal entertainment, do not expense it in your business. So that happens on Tuesday. I go to the theater and I go through Oxford Street. On Wednesday, let's say I go to a trade show. I go to a trade show, get off the train at Earl's Court or go to Birmingham, go to a trade show. I can do that on Wednesday. You see, so what am I doing is I'm doing all business stuff. Even though I'm not making any sales, because in London, I'm not generating any sales, but I am learning things. I'm visiting people. I'm going into stores. I'm visiting people that do similar stuff. I'm asking them a bunch of questions, maybe going to a trade show. That's what you can do. That makes it a business trip. So think about this from now on. Whenever you need to go overseas or anything like that, think about how you can make it a business trip. And you want to do things legal. I do not want you to do anything illegal. So that's the way you can make a trip to London, England, a business trip. Nothing complicated. You can even do local travel. So, for example, I come regularly down to Windsor to run seminars. While I'm here, I can do whatever I want. I can go visit friends. I can go visit family. As long as my key purpose here is to do business. So every day I'm going in for a seminar. That's what I've been doing every day this week. I've got a big group of about 40 people that I'm working with every day. So I'm running seminars every day in the afternoon. I can walk around. I can do a bunch of things because I'm in business. So any local and international travel, you can expense your business. That's what you want to be doing. If you sell anything and people do not pay you, you can also expense that. Okay, as long as you invoice the customer and they didn't pay you, you can expense that. So that's quite an important thing actually, because if, let's say, for example, you've sold something to somebody owes you money and they haven't paid you and it's the end of the year, you can go to your accountant and say, you know what, I've got a feeling this guy is not going to pay me. Your accountant can then put a provision for bad debts, okay, which is a really good strategy because that will delay or reduce the amount of taxes you are paying this year. So there's an example of how accountants can save you money. The other thing you can deduct is working from home expenses. So let's use that example. Let's say I live in a 1,000 square foot condo, or 100 square meters for those people that are square meter type people. If I live in a 1,000 square foot condo, and let's say that I have 3 bedrooms and 1 bedroom I use only for my business, okay? And that bedroom is 200 square foot. Okay, so my house is 1,000 square foot, or my condo is 1,000 square foot. I use 200 square foot for my business. I can deduct 20% of all my home expenses, my telephone, my internet, my rent if I'm paying rent, or the interest of my mortgage if I'm paying that. Any of those expenses I've got, I can deduct 20% of them, okay? So at the end of the year, make sure you speak to your accountant and say, this is a portion of the home, my home, that I have used for my business, and that'll reduce your tax liability. So keep this in mind. If you use 30% of your home, you can deduct 30% of your home. If you use 10% of your home, you can deduct 10% of your home. But here's the key thing. It must be a dedicated space for your business. So I encourage you to create a dedicated space for your business. then you can deduct anything. Actually, every single time you leave your home to go and see a client, or to go to Staples, or to go to the bank, or to go anywhere that's business rated, that becomes a business expense. So that's one of the big advantages of operating your business from home. Let me give you another example. This doesn't work. Let's say I've got a home office and I've got an office downtown. So really what I'm doing is I'm just creating this home office for convenience sake, so that I can deduct the expenses. Revenue Canada may not allow that, because your main place of business is your office. So just be very careful of that. It must be a dedicated space that you use for your business. And if anybody's got any questions there, just put in your chat column. But it's really key that you understand this, is that you could deduct a portion of your rent, or you could deduct a portion of the interest on your mortgage. And in a city like Toronto, this is a big benefit of operating your business from home. So I encourage you to operate your business from home. Now, some of you may be thinking, earlier on, I said to you that in Toronto, legally, you're not allowed to operate your business from home. Okay? Remember, there are two different divisions of the government. There's the municipal government, which is the Toronto local government, and then you've got the federal government and the provincial government. The Canada Revenue Agency doesn't care how you make money, even if you make it illegally, as long as you pay taxes. That's all they care about. They don't care how you make your money. All they care about is that you pay your taxes. That is the key thing. That's all they care about. If you're operating illegally, that's a city problem, not their problem. All they care about is pay us taxes and keep quiet. That's all they care about. Right, so keep that in mind. Here's another great tip. I think this is a very, very good tip, is when you go out for dinner with clients, for business lunches, dinners, breakfast, always write the client's name on the credit card. Always do that. Because then again, that's some evidence. Okay, so that's evidence that you went out on business. So that's a key thing. Also, I recommend you do this. You keep a calendar or a diary, whatever you use. So keep a diary so you don't have to remember what the expenses are related to. So get into a habit of writing on your receipts and invoices. You write, for example, office expenses. You write, for example, went out with Andrew from Biz Launch for dinner, or whatever. You write that on the credit card slip. Okay? This is what you do. It's a really good idea to do this regularly. Remember, you want to keep as much evidence as possible. So even that trip to London that we went on earlier on, you want to keep evidence that you were there for business. And the more evidence you have, the better it is for you. So this is what I recommend, even traveling. Don't go to the Caribbean on business, because it's hard to do business in the Caribbean. Most people go on vacation to the Caribbean. So just be very, very careful of this. Even if you've heard other people say, you know what, I just go on vacation and I just put it through my business. You should not do that. Or sometimes you hear people saying, I just put everything through my business. This is what people say. That doesn't make it right. Because if they ever get audited, they're going to reverse all of those. So just be very careful. Be conservative. That's what I recommend you do. But that's your decision. You decide what you're going to be doing. So let's go through entertainment and meals. When you go out with customers for a dinner, 50% of the total spent on meals and entertainment can be expense. Only 50%. So the question I often ask people is, does it pay to go out for dinner? I'm not so sure about that. Okay, I'm not so sure about that because you only can deduct 50%. Because you can only deduct 50%, you know what, I'm not sure if it always pays. So just be aware of this, is that even though you can deduct it, it doesn't always make sense. So just be aware of that. So rather than take people out for dinner, maybe have customer social events. Let's use an example. Let's say you're operating your business from an office downtown, and you decide, you know what I'm going to do is I'm going to invite my customers over to my office in the boardroom. We're going to have a bit of a discussion, have a couple of pizzas, this and that. That is fully deductible, okay? So if you invite customers to your boardroom and give them pizza, that's fully deductible. If you take customers out to dinner or breakfast or lunch, only 50% of it is deductible, okay? The other thing they allow you to do is, these big not trade shows, sorry, these big conventions, where you go and learn stuff and things like that, is they allow you to go to 2 every year. But trade shows, you can go to as many as you want. Seminars, you can go to as many as you want. All of those things, you can go to as many as you want, okay? So keep that in mind. So all those are deductible. Now, the other thing you can give is you can give your employees 2 tax-free gifts, but it can't be cash. You can give them gift cards. Let's say, for example, it's my birthday, and I work for you. You can give me a $250 gift card, and then at Christmas time, you can give me another $250. So $500 a year, you can give your employees. 2 by $250, you can give them, and they become business expenses. So that may be one of your incentives. Instead of paying people cash and being taxable, you give them 2 $250 gift cards. There you go. And it's got to be on special occasions, birthdays, Hanukkah, Ramadan, things like that, whatever. I don't know if you give them at Ramadan. Anyway, what do I mean tax-free? What I mean tax-free is that it reduces your expenses, and it's tax-free for the employees, okay? So tax-free for the employees. That's what I mean tax-free. So your employees do not pay tax on those gifts, because most things, if you give your employees a bonus, let's say at the end of the year, you give your employees a bonus of $1,000, they will pay income taxes on that. Or let's use another example. Let's say you provide your employee a parking spot. You pay for the parking spot. That's taxable on their tax return at the end of the year. Okay, so there's an example. But if you give them 2 of these non-cash gifts, $250. So just keep that in mind, is you've got to make sure that you check these things. So these things are tax-free to the employees, so they don't pay taxes on. It's only $500, so don't get too excited, but it's better than nothing. So keep that in mind. All right, so let's move on. Motor vehicle expenses. This is a very important one. You can deduct all motor vehicle expenses. Doesn't matter who owns the vehicle. As long as you use it for the business, you can deduct it. So if the business owns the vehicle, okay, so the business owns the truck that you bought, all the expenses can be deducted. So let's say you lease a vehicle. The amount you pay on the lease, the repairs and maintenance, the tires, everything that you expense on that truck becomes a business expense, okay? So an expense for the business, which will reduce the taxes you pay. All right, so that's the one example. The other example is if you use your personal vehicle. If you use your personal vehicle, what you've got to do by law is keep an accurate log of the mileage. So I've got to keep a accurate log saying I went from Toronto to Windsor with my personal vehicle, which is about, I think, 300 kilometers. I think it's about 300, maybe a little bit more, maybe 350 kilometers, okay? I can deduct 350 kilometers by the kilometer amount. And this amount changes. I think at the moment it's about 55 cents, but you'll have to check with your accountant. So for every kilometer that I use my personal vehicle, I can deduct 55 cents, okay? 55 cents of every kilometer that I travel, I can deduct that. Okay, so that's the way you can do that. So if you remember, you've got to use the vehicle. Does this still apply if you're renting the car? Yes, definitely. Tina, if you're renting the car, you can put the whole expense through because it's not yours. You're renting it for business purposes. Okay, so that's what you can do. So you can deduct whatever vehicle you're using. If the business owns the vehicle, you deduct all the expenses. If you own the vehicle, you deduct only the portion that you use, okay? So that's the key thing. If you use 20% of your vehicle for business, you can only deduct 20%. If you use 50%, you can only deduct 50%. So make sure you speak to your accountant about this. It really doesn't matter who owns the vehicle. you can still deduct the expenses. So that's the key thing, okay? But do it legally. Don't do anything illegal. Do everything legal. So, for example, a lot of business owners will pay their gas through their business. They'll pay their maintenance through their businesses, all those things, and then they will take off a portion. So let's use an example. Let's say it's a business vehicle. The business owns the vehicle. The business leases the vehicle. And 80% of the time, I use it for business. And 20% of the time, I use it for my personal capacity. Okay? When I pay taxes at the end of the year, I have to put into my tax return the amount of the vehicle that I use for my personal. Okay? So that's the right way to do things. How you do it is your business. I'm just telling you the right way to do things. So make sure you're aware of this. Keep a log of the mileage you do. So keep a log of the mileage you do, and then you'll be okay, because you can deduct all of that, and it can be a lot of money. Just think of it. People like me that do, I don't know, 2,000 kilometers a month can be like $1,000. It's a lot of money. So you're allowed to be reimbursed for each kilometer of business travel. That's what you can be doing. Okay? Health and dental insurance. So let me give you an example. So if you are incorporated, okay, this is the key thing. If you are incorporated and it's your primary source of income, you can offer coverage to everybody that works in your corporation, and that can include you. So this is quite a big advantage, is that you can get yourself health and dental insurance through your corporation, but you have to be incorporated and you have to offer it to everybody that works for the corporation. So this is what I encourage you to do, is go and check with these people that sell health and dental insurance, and they will explain to you how you can put it through as a business expense. But remember, it only works if you incorporate it and you offer it to all your employees. But sometimes they change the programs around, so maybe there's an opportunity for you to expense it through your business. Speak to your accountant and speak to the people that sell health and dental insurance, and they will set it up. I always encourage you to get expert advice. My job is to just give you general advice. You go to an expert, and they'll educate you properly. Okay? All right. Then we have a thing called capital cost allowance. So if you buy any assets for your business, let's say I buy a printing machine, and it costs me $100,000, okay? And I pay cash for it. I don't know, I've got too much money in the bank, in my business bank account, I'll pay cash for it, $100,000. That $100,000 is not an expense. What Revenue Canada does, it works out how many years that printing machine will work, okay, for me, and then it'll divide the amount of $100,000 over that period of time. So if the printing machine is going to last 3 years, it'll allow me to deduct the expenses over 3 years. If the printing machine is going to last 5 years, it'll allow me to deduct it. They decide what the depreciation rate is, okay? So this is why it's important that you speak to your accountant, because all of your assets can be depreciated. Your computers, your desks, your chairs, your tables, all of your assets can be depreciated, okay? So keep that in mind. Ask your accountant what the rates are, because they change regularly. So this is what I recommend you do, is you keep a list of all the assets you use for your business, whether you bought them specifically for the business or not. Let's use an example. Let's say I start a new business tomorrow, but I don't need any new assets. I've got my computer, I've got my Mac at home, I've got a desk, I've got all this equipment. What I do is I keep a record of all that. I go to my accountant, we value it, and then we sell it to the business, or we theoretically sell it to the business anyway. So that's the way we do it. Then the business owes the money for the assets. The most important thing is I can depreciate those assets, which allows me to reduce my income taxes. This is why it's a big advantage. So understand that. If you buy any assets, like let's say you go to IKEA and you buy a desk, and it costs you less than $200, you can just put that through as an expense. You don't have to depreciate it, you just expense it, okay? Anything less than $200. So here's the very important line. Ensure that you keep an accurate list of all your assets so that your accountant can calculate the depreciation. And often, different assets have different depreciation rates, so keep that in mind. All right, so let's move on here. If you got any questions, just post them in the chat. Maybe at the end I'll open up the lines if anybody's got any questions. All right, disallowed expenses. There are certain things that are not allowed. Any personal expenses. So, your food at home, you cannot expense through your business. Even if you say to Canada Revenue Agency, you know what, I cannot work if I don't eat. That's why it should be a business expense. Not true. They don't care. Your personal food, your domestic expenses, your dog food for your dog is not a business expense. Like, if your dog is protecting you, maybe that, no, you can't put your dog food through. Anyway, any inventory that you take for your personal use, can't do that either. So let's say, for example, I've got a coffee shop and I take coffee home. That's illegal, okay? But people are still going to do that, but it's illegal, just so you know. Any traffic fines. Let's say, for example, I'm driving along the 401. I get a speeding ticket. The traffic cop stops me, and I say, please, you know, I'm rushing to get to a client, and that's why I got a traffic fine. That's not an expense for your business. The reason it's not an expense is you got to go to the speed limit, just so you know. So if you spend money going to those guys, those ticket guys to save you ass, that's not a business expense. Just remember that. So if you get a traffic fine and you go to a lawyer, it's not going to help. Only for that traffic fine. For other things, you can deduct, but not for that traffic fine. If the government penalizes you, let's say, for example, you pay your income taxes late, or you pay your payroll taxes late, those are not expenses for your business. So make sure you pay things on time, otherwise they're going to penalize you, and it's not a deduction. It's not an expense for your business. Keep that in mind. All right, let's see what else we got here. All right, so now I'm going to show you how you can save money if you incorporate. So that's what I'm going to show you how to do. How do we save money if we incorporate? Now, it pays you to incorporate if your business is making profit. Let me say that again. It really only pays to incorporate if your business is making profit. If your business is not making a profit, it typically doesn't pay to incorporate. So, this is when it pays to incorporate, is you're not withdrawing all the profits. If you are leaving the profits in the business, it pays you to incorporate. And I'm going to explain to you now why. If your business is growing and you're making profit, it pays you to incorporate, okay? If your business is growing and you're increasing your receivables, it pays you to incorporate, okay? If your inventory is growing, your business is growing and your inventory is going up, it pays you to incorporate. So there's quite a few situations where it pays you to incorporate. And if you're purchasing assets. So understand this is when it is. So often people will say, when should I incorporate? And I always say to them, you know what? When you're making profit. When you're making profit and say $60,000 or $70,000 a year, then it pays to incorporate for tax purposes. Remember, previously I told you, if you've got assets and you're trying to protect them, then it pays you to incorporate to protect your assets. Now I'm saying to you, you can pay to protect your assets and you can use it to save taxes. So big, big advantage. This is an important slide, is that evasion of tax is breaking the law. If you falsify information, if you don't put cash through the business, all of those things which you and I have seen other people doing, we do not do these things, but other people do them. That is evasion of tax, and you can go to jail for that. And you'll see that the Canada Revenue Agency is now trying to put some really wealthy people in jail. I don't know if it's going to work, but they're trying to do it for not paying taxes on income that they earn. So there's a very good example of what the government is going to try and do, is put those people in jail. So there's an example. All right. So, but tax avoidance is legal. So that is legal. So tax avoidance and tax planning is legal. This is using legitimate ways to reduce your taxes, legal ways to reduce your taxes. I'm going to explain a couple of ways for you now. So I'm going to explain to you a couple of ways that you can do it, which are very, very simple, but very effective. So just before we do that, I'm just going to show you an example of how you calculate how much taxes you have to pay. Let's say, for example, you've decided, you know what, I want to check my accountant. And I am not sure if I'm overpaying. So there's a calculator called a simple tax calculator. Okay, that's what it's called. You just go to Google, you type in simple tax calculator. You go into this, and it'll tell you what taxes you pay. So we in Ontario, I'm self-employed. This year, I'm going to earn $60,000, okay? And so I'm going to earn $60,000. So this is how much tax I have to pay, $14,952. Okay, it'll tell you exactly how much taxes you have to pay. Let's say, for example, that instead of earning $60,000, I'm going to earn $40,000. Because I'm incorporated, I'm going to take dividends of $20,000. Okay, there you go. Now I only pay $9,162. You see the difference there? When I took $60,000, my taxes were, when I took $60,000, my taxes were $14,000. When I took $40,000, my taxes were, sorry, with dividends, let me just put the dividends. I still took out $60,000, except I took it as a salary and dividends. I only pay $9,162. Okay, so $9,162. So that's one of the big advantages of taking your revenue out as salary and dividends. You see what I did there? So there's a very good example of how you can do it. Let's use an example. Let's say I took $60,000. I took $60,000, and during the year, I paid my taxes. I paid $14,952. So I'm a corporation. I paid taxes during the year of $14,952. Okay? So at the end of the year, I owe no taxes. But let's say I took a dividend at the end of the year. Okay? So I took a dividend at the end of the year. Now, what I've got to do is I've got to pay the difference over. So I paid $14,952. My total tax is $16,000. I've got to pay the difference, which is $1,500. Okay? So one of the questions here, what is the dividend? So let me explain to you what a dividend is. At the end of the year, I'm a corporation. I pay out profits, after-tax profits, to the shareholders. Okay? And that we call dividends. So that's what dividends are. Those are profits that the business has made, the corporation has made, which is paid taxes on, and it pays out that as profit. Okay? So that is what a dividend is. Everybody understand that? So I encourage you to go and check this calculator, because it'll really help you. It'll really help you. So let me just go back quickly. I just want to check the tax rates on $100,000. Let me just see this here. I want to show you. All right, so let me tell you something here just quickly. Let's say I am a sole proprietor. Okay, now you've got to concentrate now. I am a sole proprietor, and last year, my business made $100,000 of profit. Okay, so I'm a sole proprietor. My business made $100,000 of profit. Okay, the taxes I will pay is $28,000, $28,183. That's how much taxes I pay. If I am a corporation and my corporation makes $100,000 of profit, I pay $15,000 of taxes. Okay, $15,000 of taxes. Do you understand? So that is the difference, is that if I'm a corporation and I'm a small business, I'll pay $15,000 of taxes because I'm incorporated, which is really an important thing, especially for a growing business. Because I'm sure you have heard business owners say things like this. They will say that we keep all the profits in the business. What they mean is that if we keep the profits in the business, we only pay 15% taxes. So that's the small business tax rate. Okay? So understand that. But the key thing is that you've got to keep the money in the business. So the tax rates for corporations is 15%. If you're a sole proprietor, the taxes are based on how much you earn. So let's use that example. Let's just cross this kid out here first. All right, so last year my sole proprietor made $100,000 of profit. I have to pay $28,036. Okay? If I was a corporation, I would only pay $15,000. Okay, do we understand that? But as long as I leave the money in the business. Because if I pay the money out, so let's say that $100,000 of profit, my corporation paid $15,000 of taxes, and the other $85,000 I take as a dividend. Let's use that example. So my corporation made $100,000 of profit last year. It was a corporation, so it has to pay $15,000 of taxes, and then I take the rest out as a dividend. Okay? I will pay $3,558 in taxes. Okay? So altogether, I've paid $15,000 in my corporation in taxes, and then I've paid another $3,558 on taxes on the dividends. So basically, I have paid $18,000 in taxes. Do you see how I save? By rather taking dividends. So I saved a lot of money by rather taking dividends than taking a salary. So this is where it's really, really important that you take out a dividend rather than a salary. So that's one example. And for some of you that are not mathematically inclined, I want you to understand this. This is why you get an accountant to see if you can save money on your taxes. Let me give you another example. Let's say I'm in business with my partner. Okay, let's say I'm in business with my partner, and instead of me earning $100,000 a year, we each earn $50,000 a year. So we come up with an agreement, and we earn $50,000 a year. So what happens is, if I earn $100,000, my taxes are $28,000. If I earn $50,000 each, our taxes are only $19,994. Okay? So that's a key thing, is you've got to understand that if I split my income, I can save. And this is one of the reasons that business owners employ their family, because then they can reduce their tax liability. So instead of one person earning a lot and the other person earning a little, you both earn an equal amount. But the most important thing is that you have an agreement, a written agreement with anybody out there. So one of the questions Marcel asked, doesn't dividend become earned on your income taxes? Well, that's why I showed you this over here. So that's what I showed you this over here, is if I earned no salary from employment, but everything on dividends, this is how much I'm going to pay in my personal taxes. Okay? So my corporation paid $15,000, okay, and I paid $3,558. So in total, we paid $18,000 instead of $28,000. So that's the big advantage of taking dividends rather than a salary. So if you've heard business owners saying that, I'd rather take a dividend than a salary, that's what they're talking about. All right, so let me just summarize quickly, because I don't want to confuse you. This is what I recommend you do, every single one of you. If your situation is complicated, get some legal advice. You don't have to, but for some of you, it may be more comforting sitting down with a lawyer for an hour and they're explaining to you the pros and cons of what you're doing. So it's really up to you. For some of you, I don't think you should be wasting the money, but it's up to you. You make the decision. And maybe you can get a free hour from somebody. If you speak to the city of Toronto at the Small Business Enterprise Center, maybe they can arrange that for you. There's a guy that comes there on a Friday. Understand all the legal requirements. So make sure you do that. You register your business. You get a HST number if you need to. You register your employees. You register for payroll taxes. You do all those things. Okay? Get yourself a good accountant or a very good bookkeeper. But you need good people. Develop a good bookkeeping system where you collect information and do some tax planning. And if you do that, it's going to make you a much better business owner, and you're going to sleep much better at night. So understand the importance of this, is that this could be the solution for you. You could sleep better at night, and it could be a winner for you. So make a decision about this, get advice, speak to an accountant, and you're going to sleep better at night. But you've got to make sure that you put every single legitimate expense through your business. That's what I want you to do. And do not pay too much taxes. Because you don't have to, you're a small business owner, a lot of your expenses you can put through your business, but you got to do it legally. And that's what I encourage you to do.